We're in a stock market correction. So what happens next? What returns can we expect going forward out of the stock market given where we are today?
I've got a small query for you. What comes next?
Well, I'll give you my answer after this short disclaimer. Every stock market correction is unique. Unique in what the specific trigger was. Usually it's a financial trigger, but what's unique about this market correction is that it's been caused by a global pandemic. A pandemic that's caused, for a lot of countries, the major portions of their economy to shut down all at once. What is not unique about this market correction is the panic and the panic selling that's come with it. That happens in every stock market correction. Our evolutionary history is partially to blame for this. Our ancestors had some real-world risks. They had predators. Will they have enough food? Running out of water? Do they have adequate shelter? These real-world risks really ingrained in us a fear of uncertainty. If we didn't take the risk serious, it could prove to be fatal. If we underreacted to the threat of a predator, well, we're dead. But if we overreact to a predator or overreact to any risk back then, and it turned out to be nothing, we really didn't lose anything. This better safe than sorry reflex was a great survival mechanism back then, but it's a terrible survival mechanism in the real world, especially when we have to deal with modern financial markets. In the modern world, money equals life. When we see our money going down, like the stock market going down, we get into a very stressful situation. It's our amygdala firing up, it's creating that stress environment and forcing us to take an action. So in this case, we need to sell the stock that's causing all that stress. But you're not the only one being stressed. Everyone else is being stressed too. And they're probably selling as well. So you're selling, they're selling, it starts creating this herding effect. And there might have been other groups of people that were staying the course, trying to stay cool and rational, but when they start seeing a bigger group of people sell, they start thinking that the group knows something that they don't. So they join in on the selling as well. And if you've been frustrated or laughing at all the panic buying going on with toilet paper, this is the herding effect in action. Someone sees another person buying a bunch of TP, so they think they should too, and then more people see this and think that the TP hoarders know something everyone else doesn't. And the next thing you get are fights in the grocery store over toilet paper. If we can't be rational buying toilet paper during a pandemic being caused by a respiratory disease, what chance do we have to be rational when the stock market is selling off? But let's give it a shot. To have some sort of chance of acting rationally, we need to come up with a base rate. Or to put it another way, what are the average returns of the S&P 500 given where we are with the stock market correction? As I record this, the S&P 500 is down around 34% from its all-time high in February 19th of 2020. So given where we are now with the 34% correction, what returns going forward can we expect based on past events? This first chart is going to come from Michael Batnick at the Irrelevant Investor. This chart shows the average return of the S&P 500 at various time intervals after a specific percentage decline. So we're here, and from here the average expected returns, our base case, is above average market returns for the long term. So then the question is, would you like to invest here to get these above average market returns going forward? But let's frame it another way. This exercise comes from Nick, who blogs at Of Dollars and Data and is a colleague of Michael Batnick. Like I said before, the S&P 500 peaked back on February 19th. Was around 3,386. So to retrace this correction is going to take a 51% return to get right back to that February 19th level. And then the question is, how long do you think it's going to take the S&P 500 to get back to that level? Do you think it's going to take 10 years? Well, then that's a 4.23% compound annual return from here. 5 years? That's an 8.64% compound annual return. Now 3 years? 14.81% compound annual return, and then 2 years, that's a 23% compound annual return. So let's take 5 years as the base case. Would you be willing to invest now to earn about an 8.64% compound annual return with the risk that maybe if it takes 10 years, you're only going to earn 4.23%? And then you got to remember the US 10-year Treasury is yielding less than 1%. The other thing that we should pay attention to is the worst case. We don't really need to think about the best case because that's always going to be good. We'll let that take care of itself. What we want to know is if we invest today, if we take the risk, what is kind of our worst outcome or what is our poor outcome? This chart again comes from Michael Batnick. It's just like the first one, but this one is the worst case scenario. So the risk is there's more losses over the next year in low but still positive returns 3+ years out. And the longer out you go, higher those returns get. So you have to ask, is the risk for potentially low positive returns to earn above average returns worth it? And that's what investing is. Are the rewards worth the risks? Given where we are right now, we think they are. Now, to borrow a line from Howard Marks, is it the time to buy? Is this the absolute bottom? Is this a once-in-a-lifetime opportunity? I don't know. But it is a time to buy. And that's what we're doing. Buying positions that we think are worth the risk. This video was kind of a follow-up to our previous video that you can see here. And if you like this video and you've liked any of our other videos, please hit subscribe so that you can catch all our future ones. Until next time.